Alright, Chapter 3, I'll do the first section here, 3.1. We're talking about payroll records, and employee earnings and their deductions. So you've read through the chapter already. Let's talk about some of the vocab here. Salary, money that you're paid for any of the work that you do. Federal, state, local laws require that employers keep track of these records. The period that's covered by a salary payment is called a pay period. Pretty simple. Total amount earned by all employees for the pay period is called a payroll. Okay, so pay period is the amount of time that you work. So if it's weekly, bi-weekly, monthly, whatever it is. Payroll is going to be the business's expense for the total amount earned by employees in a pay period. Payroll taxes are any taxes that are based on that payroll right there. Periodically, the employer must pay the government all the payroll taxes that we withhold. Remember, we withhold the money from the employees and then we owe it to the government. So the employees don't pay it themselves, we take it from them and we pay the government. So that's our payroll taxes. Let's see here. W-2 is the form that we use yearly to report each employee's taxes, so they know what they paid in, what they owed, all that good stuff. Withholding allowance. This is the amount that employees, individual employees are allowed to claim withholdings, which brings down the amount of money that they have to pay taxes on. So if you make $50,000 and you have some withholdings, you can only be taxed on, say, 40,000 of that, or 35, or however much it comes down to. So it lowers the amount, lowers the total earnings that each person are required to pay taxes on. Okay? So there's a lot of different allowances, whether you're married, you have kids, disabled, there's all kinds of things in there. The tax base, remember we talked about last year, it's the maximum amount of earnings on which a tax can be calculated. So you only have to pay, on certain taxes, you only pay up to a certain point. Once you make over that, you don't pay tax on that anymore. Income tax is not one of those. Social Security tax is one. So Social Security tax, the base is $87,000. That's going to be used in this book. So if you make more than $87,000 in a year, the rest of that money is not taxed for Social Security. Okay? And they use 6.2% for Social Security. Medicare in this book, there is no base, so Medicare is charged on everything that you make, and they're using 1.45% in this book for Medicare amount. Now remember, there's 3 taxes that you always have to pay. That's the federal income tax, Social Security tax, and Medicare tax. In addition to those, some states or cities might have their own their own other taxes they have to pay, but we're not going to be worried about that here right now. This is up here is kind of a breakdown of what we're worried about. In addition to taxes, employers also make deductions for employees' health insurance, life insurance, pension, savings deposits, things like that. So as a business, we're required to take care of that for them as well. All these different withholdings and allowances can have a huge effect on the amount of money a person actually gets to take home. Flip over to page 62. We talk about employee earnings. This is just an example of kind of a timesheet. This employee worked 40 hours, regular hours in week 1. They worked 2 overtime hours in week 1. Week 2, they worked 40 regular hours and 3 overtime hours. So this is bi-weekly, so it's every 2 weeks. It shows you down here how to calculate. This is pretty straightforward. 80 hours in the period, they got paid $7 an hour. They made $560. 5 overtime hours at $7 an hour times 1.5. Overtime is paid at 1.5. So you could take that as times 5 times 1050, or they're just doing it the long way. 5 times 7 times 1.5, 5250. Add that all up, $612.50 is what they made. But that's not what they get to bring home. That's the total earnings. So remember, this is before taxes and withholdings and all that. On the next page, 63, talking about a commissions record. This is for employees who are paid not hourly, but if they get paid a base salary, they might also get commission on top of that. So a lot of times people get paid a salary where it's not based on how many hours you work. You just do the job, you get this much money, but then you can also get paid commission. And there's steps here for filling out a commissions record. Pretty simple. It's pretty straightforward. Total sales from the company, which would come from the journal, plus any cash and credit, or total sales on account, plus cash and credit card sales, gives you total sales. Any sales discounts, sales returns, you're going to subtract those out. So you get our net sales. So total sales minus discounts and returns is net sales. This person gets a commission of 1%, so times 0.01, and this is the amount of commission they actually get, $328.84. So this is some ways that businesses pay employees. Might be a salary plus commission. So that's how I figure that out. That's pretty common. Payroll register. It's kind of hard to see on here, but hopefully, let's turn the lamp on here. Might help a little bit. But you have your book in front of you as well, so this is just to walk you through. Payroll register is what we got here. It's a business form that's used to record payroll information. Okay, pretty straightforward. And you did see this last year as well. On the left, on page 64, they have the steps for filling it out. Let's just walk through. The period that the date ends. Okay, so it's a 2-week pay period, so the last date of the pay period. Number 2, you're going to record the date of the payment when it's actually being paid out. So if it ended on the 2nd, it's actually paid out on the 9th. Usually a week lag. That's pretty standard. Number 3, excuse me, enter the employee's name, number, their marital status, number of allowances. All that's going to be filled out on their employee identification card, so you know this. Number 4, write the total hours worked, regular hours, excuse me, total number hours worked right here, 85. And we know that in this period, the regular work is 40 a week, so they must have 5 overtime. So we calculated out, we already did this. Regular overtime total. Now, something new here is that this company keeps track of their payroll by departments. So they have video department, audio department, and they also have a separate one for admin. It's administrative people. These are the people that are getting paid salary plus commission. Okay, these people are hourly. Administrative is getting a salary and probably commission. So we have 3 columns to keep track of here. Number 6, we're going to enter in all their deductions. So if we look through here, federal income tax was $6, state income tax was $30.63, Social Security tax was $37.98, Medicare $8.88, and under other, we have health insurance and life insurance. We kind of squeeze them both into one category there. So you write a H for health and L for life, and you squeeze them in, write them small, squeeze them in there. Federal income tax withholding is calculated using the withholding tables, such as shown on the next page. Okay, so if you flip to the next page real quick, you'll always have these tables when you're doing these problems. One for a single person, one for a married person. We did these last year as well. You find out how much they made. They made at least $600, but less than $620. You follow along. If they have 3 withholdings, bam. Excuse me, if they have 2 withholdings, you get a 6. If they have 3, it'd be 0, and so on. So you just chart it out, find where they meet. And these are pretty easy to do. The state where this company operates calculates state income tax at 5% of total earnings. Social Security tax deduction for the biweekly period is calculated as shown right here. Total earnings is $612.50, which is right here, $612.50, times the Social Security tax rate. We know that's 6.2%. Gives us $37.98 Social Security tax. Medicare's total earnings times 1.45 gives us $888 right there. Health insurance deduction is going to be given to you, or they're going to give you how to calculate it. And here they're telling us it's 16 bi-weekly for health and 12 for life. So total $28 for those two. Total deductions right here, we just add them up. Net pay then is our total earned income minus our total deductions. Okay, so total earnings minus total deductions gives us net pay. So here minus here gives us here. You have to do that for each employee, and then also you'll notice you're going to total up each column. So once you get all your employees in, we're going to add up all the columns, and we can check with the same thing. Here, total minus total should still give us net. Okay, so it's kind of a way to double check as we go through. And we talked about these. Employee earnings record, current period total earnings minus previous period total earnings gives us new accumulated earnings. So accumulated earnings is going to be something on each individual's employee record. This accumulated just means how much you've made up to this point for the year. Okay. Why is that important? Because as we said, certain things you stop paying certain taxes when you get to a certain point. Okay. For example, employers pay federal and state unemployment taxes only on the first $7,000. So once this goes over $7,000, employer doesn't have to pay unemployment tax anymore. Social Security is the same way. Tax base is $87,000. So once we go over that, we don't have to pay it anymore. Medicare, we do the whole thing. Okay. But on the individual employee record, you're going to fill in their total earnings and their withdrawal or their deductions and all that. But then the last thing is accumulated. So it's just a running total. So it just keeps adding and adding and adding.